Hi there, my name is Ron Pereira, and I'd like to welcome you to the first module of our Lean Accounting course. Well, in this course, we'll provide an overview of Lean Accounting and show its importance to any Lean thinking organization. And we'll also discuss the problems with traditional accounting when implementing Lean, and then introduce some of the tools and techniques used to combat these problems. Additionally, to provide some real-world insights into Lean Accounting, we've interviewed Lean Accounting pioneer Gene Cunningham, which you'll find in the Gemba Live section of the website. To be sure, Lean Accounting can be a difficult subject, and we'll do our very best to explain the concepts in a thorough yet concise and understandable manner. But rest assured, by the end of this course, you'll be able to see the value of Lean Accounting and be comfortable communicating this value to others in your organization. But to get things started, we need to cover some important introductory concepts. Well, specifically, by the end of this module, you'll understand some of the differences between traditional and Lean Accounting and why Lean Accounting is an important part of your organization's Lean journey. And you'll also understand a difference between applying Lean to accounting processes and the role accounting plays to support the Lean enterprise. And finally, we'll introduce some of the Lean Accounting tools and techniques we'll be exploring throughout the rest of this course. Okay, well, let's get started by discussing some of the differences between traditional accounting and Lean Accounting. And we'll go ahead and begin by addressing the elephant in the room, and one reason organizations hesitate to make any changes to their accounting practices. And this elephant is known as the Generally Accepted Accounting Principles, or GAAP. Now, we'll discuss how Lean Accounting is compatible with GAAP throughout this course. In fact, we know of no companies using Lean Accounting that have reported problems dealing with auditors so long as they kept the auditors informed during the changes. Furthermore, there's nothing stated in GAAP that requires the use of standard costing. Now, this is a big concern for people, so we cover this point more throughout the course. Okay, well, let's get started by exploring some of the reasons traditional accounting doesn't support an organization's Lean journey. And as you'll see, traditional accounting not only doesn't support Lean, it can actually work against it. One reason for this is that traditional cost accounting considers inventory to be an asset, which can motivate people to produce as much as they can, leading to the deadly waste of overproduction. As such, when properly accounting for Lean, it becomes clear that having a focus on creating smooth flow and incredible customer value actually frees up cash within the organization. Well, traditional accounting also tracks detailed information by department and motivates people to focus on the success of their department, even at the expense of the organization. Now, a common example of this silo thinking comes at the end of the year when departments scramble to spend their remaining budget dollars so they don't lose them the next year. In other words, did everyone really need a bunch of new office supplies on December 29th, or did the old staplers work just fine? Now, it's because of situations like this that many companies who practice Lean Accounting actually consider the budgeting process to be a waste and actually eliminate it altogether. Next, traditional accounting can also be expensive and wasteful because it tries to measure everything in extraordinary detail, which requires dedicated people spending hours of time preparing documents few people understand or even use. Now, this information is not only difficult to decipher, it's often provided too late and doesn't align with what the customer wants and needs. Now, this traditional information can also be misleading, wrong, and even harmful. An example of this is how the cost and price of products are traditionally determined. For example, labor costs are often treated as variable, yet in reality, they don't actually vary much at all. Conversely, Lean organizations seek to determine what customers value and how much they'll pay for that value. In other words, the price is set by the customer, and through continuous improvement and elimination of waste, costs go down and profit goes up. Now, as we touched on earlier, traditional accounting can be complex and confusing to most people in the organization. Terms such as overhead absorption, double entry bookkeeping, debits and credits, accrual, depreciation, general ledger, variances, and many more terms aren't always easy to understand without proper training. The confusing reports and requirements to track everything in excruciating detail often contributes to accountants being isolated from the rest of the organization and looked at as bean counters instead of important team members. And to make matters even worse, the people actually charged with making improvements don't have the information or knowledge needed to develop and justify improvement projects. Put another way, when this happens, the financial side of the business often becomes a mystery, requiring the invocation of the oracles of finance. Conversely, in a lean organization, as transactions are eliminated and measures are simplified, accountants are freed up to become strategic partners in helping the team continuously improve the value they deliver to their customers. Now then, in order to start freeing up accountants so they can add more value as internal consultants, we need to quickly clarify some confusion when we talk about lean accounting and its role in supporting the lean enterprise. The confusion comes from a distinction you might hear between lean accounting and accounting for lean. Now, often, people only think of lean accounting as applying lean techniques such as 5S to the accounting department, but this is only part of what we call lean accounting. Lean accounting also refers to the different approaches accountants take to support decision-making, such as make versus buy, pricing and costing, inventory valuation, performance measures, and, in general, providing the right information to the right people at the right time. Now, as accountants begin to understand and apply lean accounting to their organization, they'll transition from being a roadblock on the lean journey to energy boost that helps accelerate value creation. Now, with this said, in order for this to happen, the accounting process must support the following 5 principles of lean. First, organizing around value streams means traditional costing gives way to value stream costing. And by providing timely and visual information, accounting helps support flow and pull. Next, performance measures change to focus more on creating value for the customer, and employees become more empowered when accountants work with them to create simple measures that can be calculated frequently and provide actionable information. Lastly, all associates, including accountants, drive to continuously improve their own processes in support of the overall pursuit of perfection at the organizational level. Now then, since principles guide behaviors, a new set of accounting tools are needed in order to act on these principles. As such, throughout the remainder of this course, we'll provide and explain some of the tools used by lean accountants, including value stream costing, target costing, box scores, and plain English statements. And we also promise to deliver this information as clearly and concisely as possible. Okay, well, in our next module, we're going to cover some basic accounting concepts before diving into more advanced topics like value stream costing. So, we'll speak to you soon.